Hey everyone, welcome back to the Daily Gold Podcast. Today I'm speaking with Tiho Brkan. He's the author of the Short Side of Long blog. He's also a fund manager based out of Hong Kong and Australia. Tiho, great to have you back. How are you today?
Excellent. What about yourself?
I'm doing pretty well. It was a pretty good week for some precious metal shares I've been following, but who knows how long that's going to last. Anyway, I wanted to commend you on your great call on Apple. You actually posted something which I think was actually days within the top, where the title of your post was "Is Apple the biggest mania of our lifetime?" And you posted about how the market cap of Apple was so ridiculously large. It was bigger than I think all of the pigs, and bigger than many countries in Southeast Asia. And that stock has come down 20%, which that's pretty substantial for a company like that. For a lot of us gold bugs, a lot of our stocks can move 5-10% in a day. So for some of our listeners, 20% doesn't seem that much, but I want to remind them that 20% for a company like Apple is very significant. Anyway, anyhow, let me get to my first question. I mean, you've been right. The market is starting to turn down, and I just want to know at this point, what specific sectors do you think look vulnerable? Is it the junk bonds sector, or is it the transports? I mean, we've seen a decline in Apple and other tech stocks, and the S&P has come down. But now that we're kind of at the beginning, or I should be, past the beginning of this cyclical bear market, I could say, what do you think looks vulnerable here and now?
Well, first of all, thank you for the nice comments regarding Apple. Um, you know, I guess every now and then, even I manage to get something right. I'm not as good as the CNBC crowd, but I try. Regarding the sectors, it's very good that you've noticed that some sectors look more vulnerable than others, and the question is how they're going to all play out from here onwards. Traditionally, usually early cyclical sectors like technology and semiconductors start to underperform first, and we've already seen that phase, and we might continue to see that phase in months and quarters ahead if the bear market continues, which I think it has already started. But eventually, we also have, underperformance starts to occur in discretionary sector, including retail, which starts to get affected as consumer discretionary spending by the citizens of the United States, I think, was going to pull back. And also, I think home builders are going to start underperforming too. So I can, those are all the sectors that I'm currently short in one way or another. So I can tell you, I guess, what I'm doing with my money, and I have shorts on technology sector. I have shorts on Apple as of late August, in early September as well. And I have recently sold some calls on home builders because they have almost, I think, more than doubled over the last 52 weeks, which is insane. Which is, good on the people that have invested in home builders. But I think this whole recovery in the housing sector is definitely underway in America. The price of housing has gone down a lot, but I think the shares of the home building sector have really run ahead of the fundamentals. So they've gone up a little bit too much. And at best, I think they might go sideways, and at worst, they might correct and pull back significantly, especially if what I'm forecasting occurs, which is a recession into 2013-14 time period. And also, finally, like I said, consumer discretionary, I have some shorts there, and I've recently sold some calls as well on the retail sector, including junk bonds. I think I was actually looking at junk bonds today before we did this interview, and I was looking at the credit spreads across the whole world, thanks to the Merrill Lynch indices. So, first of all, I think credit spreads and volatility measured by the VIX, or implied volatility by other measures, is extremely low on all asset classes, be it currencies or commodities or interest rates and equities. And I think credit spreads are also in the same type of area. I think they're all going to start to rise. I mean, I've noticed that in Latin America, corporate credit spreads are starting to rise. I've noticed that in Asia, corporate credit spreads are starting to rise. I've noticed in Eastern Europe, corporate credit spreads are starting to rise. So all these emerging countries, are experiencing a bit of a risk-off environment, just like the stocks are. And at the same time, I think with the bond market still continuing to rally, I think that credit spreads will have to definitely widen much more before any of these assets actually could be considered as an opportunity to buy. I think, in other words, credit spreads are very, very low, and junk bonds here look very vulnerable. I've shorted junk bonds and I've remained short. I think this is where the major crisis could occur in America. I have noticed that thanks to Ben Bernanke lowering rates and moving pension funds and other funds up the risk scale, he has created a very dangerous environment investing. In other words, some pension funds that used to invest in treasuries find the yield very low. They've moved into corporate bonds. And some corporate bond investors and other funds that invest in corporate bonds have found the yield to be way too low now, and they can't actually get the return that they're after. So they've moved into the high yield. And there's comments on TV, on CNBC and Bloomberg, that the high yield market is not actually called high yield anymore because the yields are at record lows of 6.8% or something. It's very dangerously low, and I think with so much issuance occurring and such low interest rates and such high euphoria about retail investments and mums and dads, with inflows into junk bonds reaching records, I think the dangers really are really found in this sector. So I have shorted junk bonds, and I have also sold calls on the junk bond market too.
Yeah, and I just want to provide some context for what you said there at the end. You posted a chart. The post was this Tuesday, November 6th. The topic of your post, or the title, I should say, Sign of Capitulation, Are We There Yet? The first chart you posted showed the flows into bond funds, and I guess that includes all bond funds, and it actually reached a record. And so some of us might look at that and think, well, we got to short treasury bonds. That's it. That's the top. But I mean, in reality, because of what you just said, the majority of these flows are going into junk bonds and those higher yield bonds. And it's interesting because if you look at the chart and you look at the reverse, where the flows were very negative, it appears to me that at those points were actually important lows for treasury bonds. So, I mean, Tiho, do you think we could have a dichotomy here where the U.S. government bonds start, or I shouldn't say start, but they continue to rise, whereas the higher risk corporate bonds start to turn down and fall apart?
Yes, you're definitely correct. So I want to commend you on your observational skills. They're very great. You've managed to figure out what majority of investors don't, because it's very common when a certain phrase or a buzzword gets created, like large inflows, record inflows into bonds and bonds this and bonds that. A lot of investors don't actually do their own research, unfortunately, even though it's their own money. And majority of the time, actually, these professionals and gurus, it's somebody else's money. They tend to herd and then just follow the character that said this next to them, or the guy that said this last week, or the guy that spoke about that 1 month ago. They actually don't do their own research. So you're definitely correct in saying that when we look at bond inflows, yes, they're great. And from a contrary point of view, one wants to eventually be invested in stocks because all the money is going into bonds. But if we dissect this inflows, majority of the money is actually going into these risky bonds. And as you well observed yourself, it is the treasuries that have been unloved, for example, since June of this year, when the risk assets bottomed and junk bonds rallied and corporate bonds rallied and emerging market bonds rallied, and treasuries sort of went sideways and corrected and sold off, and everything calmed down with the Greek saga and the elections. And then it was Draghi and Bernanke who sort of propelled the risk assets higher, and treasuries sort of moved sideways. Now we have a reversal of that, where treasuries actually seem to have broken out from a tight range between the 50 and the 200-day moving average that they've consolidated in, and they look to want to make a new high. Because there has been a lot of outflows and there's been a lot of selling, and as you said, majority of this money has moved into junk bonds and corporate bonds. So when credit spreads rise, what would happen is the money would go back into treasuries and leave these riskier bonds where everybody has gone to. Now, obviously that should answer your question, but I just want to say one more thing. In no way, shape or form am I actually telling people that they should go out and buy treasury bonds. I think they're extremely overvalued. They're very close to a 52-week high. very close to a record high in the bond prices on the futures market, and treasuries have been in a bull market for 30 years, or edging to more than 30 years. So it's quite remarkable how long this great bond bull market has gone on for. So eventually it'll become an end. But at the same time, I've noticed that quite a lot of my acquaintances and friends in the business have been willing to play the contrarian side and try to short these treasury markets, all government bonds like bunds, JGBs. We even know some very famous investors who are trying to short JGBs in Japan, anticipating the crisis and things like that. Having said that, I don't think this rally is finished yet. This bond bull market, cyclical bull market, the last one, is not finished yet until we see full panic. So once I see equities collapse, once I see earnings collapse, once we see the recession play out, once we see the Eurozone crisis completely play out as well, once we see solutions to these issues or these crises play out, once we see the VIX and the fear really spike and people get afraid and pile into bonds properly, it might be a time to short these bonds. So that might happen in a week from now or a month from now or a quarter from now or a year from now. I'm not sure. But I definitely don't advise people to buy treasuries, but they should not short them yet until maybe higher prices occur due to the fear and the panic that might occur, happen in coming weeks and months and quarters.
And before I get to the next question, I just want to highlight what I think a very important point that you made, which is, so we have all these inflows going into the bond funds, and as you said, the large majority of that is essentially more speculative bonds. And so what happens is when that money comes out of those, what you're saying is it's highly likely that that money is going to go into treasury bonds because they're the safest.
Yes, exactly. I mean, if you overlap any chart in a long period of a junk bond price on average, or the index, over the S&P 500, you will notice that the correlations are very, very significant, and they move in the same direction. They follow the same business cycle pattern of an expansion and contraction. They fall in a recession like equity prices do, and they rise in expansion. The largest rise, like in the equity market, is at the beginning of the expansion, and then they sort of turn around more and they start to slope like equities, and they struggle to gain properly, and they sort of roll over, and eventually we have another contraction. So they follow a business cycle very closely. So if mums and dads are taking money out of equity mutual funds and putting them into riskier bond funds like corporate bonds or junk bonds, essentially they're still betting, it's a still bet on a stock market. It's just in another shape or form, using another asset or another vehicle, which still correlates to the same degree that equities correlate to the business cycle themselves. So I don't see a large inflow into treasuries, and when we do see a large inflow into treasuries, it'll most likely mean that we have huge outflows out of bonds. And that's, I think, when the equity market will bottom. Right now, while we see these huge inflows into bonds, it's an inflow. These inflows are, in particular, a bet on the stock market. So the way I see it is, I think this is a signal that the bear market in equities and all corporate assets will actually start. So by corporate assets, I mean corporate bonds, corporate junk bonds, and corporate equities. So yes, so I see a treasury. Treasury is like the only place, I guess, that's safe and that you can hide for the time being. I know it's very overvalued, and I know that personally I'm not touching it with my own money. But when you have these funds that don't invest in precious metals like we do, they don't invest in certain things, and they have the pressure from their own investors not to stay in cash and to gain returns, they look at equities, they look at all various bonds, and they look at cash. So where, with Bernanke leaving cash at zero, the choice is pretty much, unless you want to sit in cash and disappoint some of the investors by not getting a return, the only two choices are really bonds against equities. And so you get to choose there, and their choices are not that great. So they look at treasuries and go, well, I might as well just hide there for the time being. And eventually they'll all pile in, and that's when they'll all be wrong, just like always.
Okay, now let's get to the last part of our interview, which is always my favorite topic, as you know, the precious metals complex. And I would imagine the favorite topic of most of my audience, but they do love hearing about these other markets, as do I. which is why I always ask about them. But anyway, coming back to gold and silver, Tiho, you actually told me that you bought a little bit of silver, I think yesterday or the day before. Maybe you could just give your rationale for why you did that, and maybe your thoughts here, just quick thoughts on the precious metals before I get to a follow up.
Well, I'm not sure how good I am at timing things. So if I bought some yesterday, maybe you might want to wait some time to pass, and maybe prices will fall a little bit, and then you get to beat me and buy at a lower price. Having said that, my major entries into the precious metals market in recent times have been in late December 2011, as I've wrote on my blog and as you mentioned before in interviews, and also in late June and early July of 2012. And both of these purchases were made in the silver futures market, silver ETF market, and the silver options. I did buy a little bit of silver last night because, and it's only towards one vehicle, and that's the physical Sprott silver vehicle, because Mr. Sprott has issued some new shares with the promise to buy more physical silver in his vault. And the premium actually, even though silver went up, I think 1.2% last night, the Sprott silver declined by 2%. I actually have holdings there already from previous purchases, and I figured that since the premium has been reduced, I've been offered a very good entry point because the price just fell and gave me a discount of 2%, plus obviously silver rose 1.2%. That's a discount of 3% on the day, and I just thought I would add a little bit. It has no significance to my holdings really, and it's not a timing sort of a thing where I think it's the best time to buy it. It's just because that occurred, I thought I'd react and just buy a little bit. Who knows, you might end up being right. Usually when Mr. Sprott has issued these shares, every time he's issued them, I've noticed that he's always done them around close to bottoms of the silver price themselves as well. So maybe he will do it again and maybe the price will rally. But in general, I mean, I see positive things occurring for precious metals market in coming years on the long-term horizon. I think over the next 3 to 5 to 8 years, precious metals will remain in the secular bull market. I'm not sure which one of those years because we have to watch and play it. But I think we will eventually get to the final mania stage because majority of investors, majority of the money is still underinvested. I personally prefer to own precious metals than the gold mining shares. I know some of your viewers are heavy investors in gold mining shares. You know, it's I can't say that but I do well as well. I prefer metal because the future that I see occurring is one of turbulence around the world, one of turmoils and political turmoils with food prices rising, as majority of your investors and majority of your listeners should know. I've been very optimistic on agriculture since June of this year. I've told you investors in an interview to buy some, and it's gone up, and since last year as well. And I think food prices will continue to rise, and that will create more turmoil. People will come out on the streets, and more protests will topple governments. And as you know, majority of gold and silver and other precious metals are mined in these remote areas of the world with unstable countries, with unstable political systems and governments. And when that happens, like we've seen recently in South Africa, mines get shut down for a while, strikes occur, turbulence occurs, turmoil occurs, protests occur, and that's very bad for mining companies, but that's very good for the demand-supply equation of the metal itself. So if I'm right, I see more of that happening in the future, and I see some of the mining shares struggling to pump out the production that's necessary to meet the demand. That might not be good for the profit and loss of the company. And I'm not saying all of the companies will go through that, but I'm just saying some of them will be affected at different times. And that will end up being very good for gold and silver because when companies bring supply onto the market, and I think demand is continuing to rise from central banks, demand is going to continue to rise from Asia, especially China, who are beginning to buy silver at a very rapid pace, and not to mention already we know about gold. And I think also that investor interest in these ETFs is going to continue to rise as people figure out the current bull market in central bank balance sheet expansions will continue to by trillions and trillions into the future. More and more public will understand that the fiat currency system, something is going to click in their heads that something is wrong there, and then they will also start to invest in gold and silver. And when the price goes really high and it spikes, hopefully all of us, including your readers and your listeners, are smart enough to sell.
Or at least smart enough to take some profits along the way.
Exactly, whichever one. But as long as you gaining little bit by little bit, it's the best way.
Well, all right, Tiho, on that note, I think we've covered it all here today. Thanks so much for your time and your great insights as always. And I'll have to have you back soon in the next couple of weeks.
For sure. Just one more thing I would like to say for the listeners who are interested in seeing what they should buy instead of following me buying silver, maybe they should consider buying some sugar. I usually don't give out any tips. I don't really say you should buy this at this time or that at that time. But I myself have started accumulating some sugar. So if anyone's interested in commodities other than precious metals, you should consider agriculture and especially salts because they're really, really beaten down, and sugar offers some great value right here, right now.
Laura, I'm glad you got that in there, and I'll also just give out your web address, which I believe is the short side of long.blogspot.com, where all of your thoughts are posted and synchronized very well, I might add. It's a very clean looking blog with some great information there and great analysis from Tiho. All right, my friend, thanks so much for your time today, and as always, I really appreciate it.
Thank you so much. Thank you for having me on.